And hello and welcome to Beacon Pointe's Fiduciary Point of View webinar series. Just as a quick introduction, this is Doug Igel, the Director of Retirement Plan Services at Beacon Pointe Advisors. Beacon Pointe is a registered investment advisory firm located in Newport Beach, California. We currently manage over $9.5 billion in total assets. We'll be hosting a new Fiduciary Point of View webinar every 4 to 6 weeks on various topics pertaining to the defined contribution industry, both in the for-profit 401k space as well as the not-for-profit 403b space. Our goal is to bring to light various topics for both our clients as well as the general plan sponsor community, and we're trying to bring in experts in the respective fields to educate and help inform all those in attendance. Well, we just passed the testing deadline of March 15th, and we're fast approaching the individual tax filing date of mid-April. Now, with these two deadlines, we're generating a lot of questions from our plan sponsor clients and our private clients about tax planning within plans and for the individuals. With that said, we're bringing back Jamie Bosley from Prudential to give us an update on non-qualified deferred compensation plans. Just for a quick recap on what a non-qualified plan is, we look at the words in the name. Non-qualified. The plan does not meet all the technical requirements imposed on a typical qualified plan under ERISA. Deferred. The employee's receipt of compensation is delayed until a future date. Compensation. The employee can defer their regular salary, bonus, or any other type of compensation. And plan. A non-qualified deferred compensation plan can be established for one individual or can be established for a large number of individuals. Our speaker joining us today is Jamie Bosley from Prudential. Jamie has over 25 years of experience in the executive benefits industry. He's been instrumental in successfully developing non-qualified plans for both Fortune 1000 companies as well as emerging and middle market companies in diverse business areas. Jamie is a CPA and graduated from the University of Southern California with a degree in accounting. Just for some quick housekeeping before we start, we'll have the lines muted throughout the presentation. If you have questions, you can type them in via the GoToWebinar chat box on your screen, and we'll save the last 5 to 10 minutes for questions. Jamie, thanks for joining us this morning, and glad to have you back as our featured speaker. I know you have quite a bit to cover, so I'll let you turn the presentation over to you.
Great. Thanks, Doug. Appreciate it. And thanks, everyone, for your time this morning. Again, as Doug mentioned, we're going to talk about non-qualified deferred compensation plans today. And why are companies interested in providing these types of plans for their executive group? They're primarily provided to recruit, retain, reward, looking at allowing for the highly compensated to defer amounts above and beyond what the IRS caps them at. In this case, in 2018, $18,500. If you turn 50 or are older than 50, it is an extra $6,000 catch-up. So for those that are capped at those IRS limits, this allows them to defer amounts above that, well in advance of that, really depending on plan design. What we find in this next slide is really the one slide that if I had to take out to explain to any one individual, this is to me probably the most telling sign of where we are really in America from a savings standpoint. This study was done by Aon, and it basically states that comp consultants will say that folks in retirement need approximately 83% of their income as a replacement goal to live on. I would argue that if you are in a high state income tax living area like California, New York, Jersey, Connecticut, where you have a very high cost of living, that 83% number is going to inch up closer to the 100% level. This graph is showing a 45-year-old that is going to defer for 20 years. They're maxing out their 401k plan, and they're going to retire at age 65. And on the bottom, you see compensation figures, $150,000 going on out. The green line there is what Social Security will provide in retirement. So if you've got somebody that's making $200,000 a year, you're roughly at about a 20% replacement ratio, which isn't a lot. You then factor and layer on top of that your 401k balance, assuming you're maxing that out. And at about $200,000, you're in the high 40% range. And those that make more than this are really at a disadvantage when it comes to the limits that they can defer compensation. So you see that peach or red graph area, whatever that color that is what you need to do in retirement on your own. So most folks don't have pension plans anymore, and this is something that a non-qualified deferred comp plan would be very instrumental in helping executives get to that retirement savings goal of 83% or higher. So how do these deferred comp plans help solve this problem? Well, very similar to a 401k, they reduce the impact of your current income taxes. So if you defer additional $20,000 or $25,000 a year, that will lower your W-2 income for the taxable year, and you're just deferring it to a year down the road, and you'll pay ordinary income tax again. However, whether it's while you're still working or in retirement, and if in retirement, in theory, you could potentially be in a lower tax bracket than you are today. These plans offer a lot of flexibility, as well as allowing executives to defer amounts well in advance or well and above the IRS limit. And from a corporate sponsor standpoint, plan sponsor, it doesn't cost a lot to provide this benefit to the executive group of folks, very little corporate cost. So to give you an idea of what we're talking about here, this next slide really, and I know many of you, I'm sure, have seen what it looks like to defer and the power of deferral and so forth. But here, this again is taking a 45-year-old. They defer $20,000 pre-tax income a year to age 65. The account grows at 6% a year, and they take a lump sum at age 65. If they do that, they would get a lump sum check of $522,000. If they tried to do that on their own, and we're taxing that at 33% tax bracket. If you tried to do that on your own and do it through, yourself paying your taxes today, paying tax on the gain every year, and so forth, at the end of that 20-year period, you'd have roughly $430,000, $431,000. So roughly a 21% difference by allowing the account to grow tax deferred. So that's really the power of deferral and why you would want to do that. This next slide really kind of gives you an idea of how a 401k plan compares to a deferred compensation plan, a non-qualified plan. And I'm not going to go through each one of these in detail, but I'll just kind of highlight some of the topics here. One, as Doug mentioned at the top, really the top two, 401k plan is for all employees and is protected by ERISA. A non-qualified deferred comp plan, you're carving out a group of the highly compensated, okay? It's not for everyone. And a lot of times when you put a plan in the communications to plan participants, we always tell them, look, if you are not maxing out your 401k plan, whether it be the $18,500, and if you're 50, the extra 20 or the extra 6,000 to get to the 24,500, you should not even think about participating in this plan. Again, it's for those that are maxing out their 401k plan. This is an additional savings vehicle for them. It is not governed by ERISA, so there are some risks that we'll talk about here in a minute. A couple of the other things are changing your deferrals. Once you make that deferral election for the upcoming plan year in a non-qualified plan, you cannot change that election. It's binding for that year. Versus your 401k plan, you can change it as often as you want. Company contribution, if the company is offering a match from a corporate standpoint as a plan sponsor, you get that deduction today when you make that match. In a non-qualified plan, as well as a salary deferral, the company has to postpone that deduction until the individual actually takes it into income in the form of a distribution. So there's some tax deductibility issues between the two programs as a plan sponsor. Withdrawals prior to age 59 and a half, you have a penalty if you're in the 401k. If you've scheduled your distribution in the non-qual plan, you don't have that age limit of 59 and a half. You get your money when you scheduled it. You can get your money while you're still working. That's an in-service withdrawal in the non-qual plan. However, there are no loans that are available in these plans, which you do have in your 401k. In your 401k plan, your balance is portable. That means, you can take it to another employer. You can leave it with your employer. When you leave the company, you can roll it into an IRA or any other qualified type plan, and those same qualified plan rules will apply. In a non-qualified deferred comp plan, there's no rollovers that are available. Once you leave the company, you will be paid how you have been elected to be paid. From a risk standpoint now, as a participant, you have your investment risk that if you choose bad funds or the market goes down, you have that risk of loss from that standpoint. You have that same risk in a non-qualified deferred comp plan. However, the main one here is that you would be If you are a participant in a non-qual plan of your employer, you would be an unsecured creditor of the company. However, most companies end up establishing a rabbi trust, which will hold the participant deferrals, and that is doing everything that they can legally to protect the participant, except in the case of a bankruptcy. So those are some of the risks that you have there. Benefit payments, they are, in both situations, they are ordinary income taxes to the participant. From a corporate standpoint, corporation does not get a deduction on the 401k because they took it up front. The corporation gets a deduction, a corporate tax deduction, once they actually pay that benefit to that participant. And then finally, the funding. Because this is a non-qualified plan, if the company does not opt to set aside assets to fund that liability, they would have on their books an unfunded liability. But most companies do set aside assets, and they set them aside to hedge that liability from a funding standpoint. And there's a couple of approaches to that, which we won't go into today, but most companies do set aside assets to hedge that liability. And I think as Doug had mentioned, if you do have any questions, please use the online tool to ask those, and we'll answer them when we're done here. So considerations as a plan sponsor, what are you trying to accomplish? If you're thinking of adding a plan, or if you do have a plan, are there other features that you may want to think about? And so when you do that, it's always good to relook at your current plan, or if you're going through it, who can participate? What's the eligibility group? What types of compensation are we offering to be deferred? Do you have a group of salespeople that you want to include, and they're paid on commission? You may want to redo your plan document to allow for that. How are the annual deferrals allocated? Will the company make contributions? Will the plan be funded? What investment choices, and what are your distribution options? Those are really the top 7 things that you really need to think about, thinking about either starting a plan or even auditing your existing plan for those plan sponsors that are listening in today. Who can participate? Again, it's for a select group of management or highly compensated individuals, so that we want to make sure that, again, this is just for the highly compensated. Fortunately, the Department of Labor has never come out and said exactly what the percentage should be. Think of it kind of as a rule of thumb. About 10% of your total population would be eligible to participate. That's kind of a ballpark number. Again, every situation is different, so you'd want to look at that. What types of what type of compensation can be deferred? Typically, it's salary, bonus, commissions. Those are the main 3 that we see. Directors, you may want to offer your board of directors an opportunity to defer their board fees. Then a lot of times we may see LTIPs as well as restricted stock units. So there's some accounting issues around stock, so a lot of times companies opt not to put the stock in, but it is a deferrable source of compensation. Company contributions, the most common company contribution is a 401k match, so they're making the executives that are participating in these plans whole, so they're not losing any money by deferring money into the deferred comp plan. And you can have different types of vesting schedules relative to retention. If you want to give somebody a chunk of money and say, okay, based on meeting certain goals, we're going to put this in your deferred comp plan. However, it could have a 2-year cliff vest schedule, 3-year cliff vest schedule, rolling schedules, those types of things. So a lot of flexibility from an HR and plan sponsor opportunities. Will the plan be informally funded? Again, you've got kind of a hybrid solution. You could use corporate cash, pay as you go, corporate-owned life insurance, taxable securities. These are all ways that you can actually hedge that liability. And like I said earlier, most companies do offer a rabbi trust of some sort to give the participants as much protection legally as they can. But again, it will not protect in the case of bankruptcy. Investment choices, that's another plan sponsor thought process, is do you want to offer, investment type investments like a 401k plan? A lot of companies mirror what they're doing in the K plan, and they may add on a few maybe sector funds and so forth. The other option is giving them an indexed rate, a fixed crediting rate. I would say that we used to see these fixed crediting rates years and years ago when deferred comp was getting popular. We don't see those as often anymore, but they still do exist. Distribution options, again, from a state-of-the-art type of program, you'd want to offer scheduled in-service withdrawals. So think of that as while working. Executives could use this to fund a child's education, pay for a dream house, help pay off the mortgage earlier, whatever it is. But that you typically give them that option. And when those are allowed, you would typically give them a lump sum or 2 to 5 years of installments. And then when individuals separate from service, you would allow a lump sum or typically 2 to 15 years of installments. For those plan sponsors that have employees in California, New York, again, the high state income tax states, there is a source tax law that says if you take with retirement distributions in 10 or greater installments, you can avoid the state that you earned the money in. So again, for California, Nevada comes to mind, Washington, Texas, Florida, a number of states that don't have state income tax. So those are the types of things. Again, under 409A, which governs deferred comp, if you want to make a change to your distribution election, there's a law out that says you have to make that election 12 months in advance, and it pushes out for 5 years. The other item to think about is how do you want to have a plan allocated, whether it's plan year. So again, each year's deferral gets its own distribution election. Think of it that way. Or the other approach is an account-based plan. Think of that more as buckets, where you can have, depending on plan design, 4 or 5 years that you choose or buckets that you want to be paid. And then you have 1 or 2 retirement account buckets. I've kind of gone both ways in seeing from a plan design allocation. I actually started as a plan year person that I thought was the best. Then I switched to account-based. Now I've kind of gone back and shifted back to a plan year. I think it just allows a little more flexibility. But again, that's how I understand deferred, but most providers should be able to record keep both approaches. There's no right or wrong answer plan setup. So again, from a state-of-the-art deferred comp plan, from a plan design, we typically would see a diverse array of investment choices. So again, getting away from that fixed crediting rate, the ability to control when you get your money, i.e. in-service withdrawals, so I don't have to quit to get my money. I think, years and years ago, people would say, well, I have to quit to get my money. Well, no, you don't. We don't want you to quit. We want you to stay on. You're a valuable team member. So, schedule the year that you want it paid to you, and we'll get that to you. Flexible distribution options, installments, that's very common. And then again, a most tax-efficient informal funding strategy to help minimize any exposure that you would have on the P&L, which is, strictly related to the plan sponsor. We do a survey, executive benefits survey every year. As you can see here, 85% of companies offer some sort of non-qualified deferred comp. These are very, very common plans. They've been around for a number of years. We're seeing more and more companies offer or make up that company match. And what we were told is why companies offer these non-qualified plans. It's a retirement savings vehicle. They want to attract and retain their executives. And then the other one would be to restore the deferral opportunity that's limited or by the 401k IRS limit. And then currently want to throw out some questions or comments. Tax reform. I'm sure many of you followed at the end of 2017 both the House and the Senate bills, and where originally the House bill came out that was going to effectively eliminate the deferral of compensation, and the Senate came out shortly thereafter with their own version of the bill, which had the same language in there. Fortunately, that was repealed, so it makes deferral of compensation still a valuable long-term tool for participants. So there's no change in the existing tax law from that standpoint. The lower individual tax rate do provide for greater opportunity for tax planning to lower your tax bill even lower. And I think it's especially important back again to the high state income tax states where the repeal or the limit of state taxes and mortgage interest deduction, which is the government is trying to offset that by a higher standard deduction. I think we're going to find in these higher state taxes that really does hurt those states. So again, this will allow folks to get into those lower tax brackets. The federal corporate tax rate has dropped. However, state income tax rates are still in effect. And also, I think people are now starting to realize, and I've seen it in the last couple of days in the newspapers, where because of the 50% limit has gone away on entertainment. So I think you're going to see a lot of corporations maybe throttling back on some sponsorships that they cannot deduct. So I think it'll be interesting to see there. And then there's no change in the corporate taxation of deferral plans. So they still cannot get a deduction until that amount has been paid to the executive. So that's what I have. Any further questions?
Perfect. Thank you, Jamie. We do have a couple questions, and I'll actually start with the question. What have you seen as kind of the landscape with interest in companies looking at non-qual plans, we're only in the first quarter this year, but the first quarter this year versus the start of 2017?
Great question, Doug. We are continuing to see increase in, especially this year over, I would say, 2017 and 2016, that these are still viable plans. There are a number of companies, for whatever reason, that have remained on the sideline, I would say, over the past few years, and or that if they do have a deferred comp plan, they're starting to look at it much more closely and really looking at kind of revamping it and bringing it to a state of the art, adding investment to options versus a standard, fixed rate plan. So we're seeing a number of opportunities and increased interest in that.
Perfect. And this question is from someone who called in. So it's more on the participants. You talked about it a little bit, but what are you seeing regarding participation with the lower individual tax rates? Are you seeing higher participation, lower participation?
This last year, we saw, when a number of our plans again, talking from our book of business, a number of the plans had already enrolled prior to the final announcement, if you will, what the tax laws were. And we saw, again, continuing slight uptick year over year from our existing clients. We did put in a number of new plans that started in the first of the year, and, meeting with all those individuals, they actually, because after the tax brackets had kind of come out, they were spending more time trying to get into those lower tax brackets and seeing how they could manage that. So I would say a much more keener interest, if you will, trying to get into those even lower tax brackets.
Perfect. Well, I think that brings us to a conclusion of our Beacon Pointe Fiduciary Point of View webinar. I'd like to thank Jamie for joining us this morning and sharing his experience and insight on the use of non-qualified deferred compensation plans. And on behalf of Beacon Pointe Advisors, this is Doug Igel, the director of our Retirement Plan Services Group, and thank you all for joining. If you'd like a copy of the presentation or have questions, you can reach us at bpawebinar@beaconpointe.com. Thanks again, and be on the lookout for the invite for our next Fiduciary Point of View webinar. Thanks, Jamie.
Thanks, Doug. Thanks, everyone.